time to hop out on another Monday edition of the Foundation. The call that we host, myself and Luis Moyano, host at Innovative Financial Group, as well as a couple other special guests, talk about everything mortgage protection. So I think we got everyone tuned in. You should be able to see us now. It's awesome. If you're streaming in from Facebook, we have that open as well. So check out that live feed on that stuff also. So like I said, we're super excited. What we're going to end up doing today, really diving into, I'm going to take time to touch on Foresters, their SmartUL product, as well as NLG. And then if we have a little bit of time left, KCL. And then I'm going to kick it to Luis to talk about Mutual Omaha's IULE. So I'm not too familiar with that product. He is. So there's no better guy to chat about that one. But just kind of kicking things off. So as you mentioned, I said, we're looking at everything IUL, UL, ROP. It sounds like a confusing mess of stuff, right? It's actually not that complicated, I promise. Kind of going with the basics. So ROP stands for return of premium. So it's a term product to where you can pay into it for 20, 25, or 30 years. And then at the end of that period of time, you get all of your money back. It's an awesome product. It's a great win-win for that younger client that wants a guarantee. No questions asked. They want to know if they put X in, they're going to get Y out. It makes the most perfect sense. So actually, we're going to start with that one first. That one's the easiest to explain. But all a return of premium is, in very simple terms from an insurance concept standpoint, it's built off of an IUL chassis. So instead of the client making the actual interest, the insurance company makes the interest on that actual product. They're going to invest that premium that the client's paying. And they're promised to the client that they're going to get every single penny that they put into that policy back. So it's a very strong product. It does make sense. But then you're going to run into a good handful of products to where, hey, or clients that they're going to want some type of interest. They're going to want some type of return on their investment that they're spending. And that's where those IULs and ULs make the most sense to kind of stand out from that traditional ROP. So let me go ahead and start the screen share on this guy. So you should be able to see this guy. So we're going to start with KCL. So ROPs, KCL, they're going to be my favorite one to deal with. Personally speaking, they're the only one on the market that's going to give you return of premium and living benefits. There's another company that kind of offers something similar, but it's not a true living benefit. What that mean by that is that they can actually terminate the policy at any point because it says it's 100% of those living benefits. So typically speaking, KCL does an 80% living benefit, critical, chronic, and terminal illness. So it's more in line with what we like to talk about. Just note, there's, like I said, they do a 20, 25, and a 30-year option. The 20-year will be the most expensive way of doing it. So anytime you get your money back faster, it's usually going to be a little bit more expensive on the actual product standpoint. So I always like to run all my return of premiums on 30-year chassis. Like I said, ages between 20 to 55, it can make a lot of sense. It's structured for the right person. Let's do, for example's sake, we'll run this guy at 250. So $250,000 coverage for the next 30 years with return of premiums, only going to run them $125.41. So cool thing about KCL, which I'm going to show you guys this line right here, is KCL, like I said, it's always going to be, anytime you build any type of cash value, sorry, let me admit these guys. Let me drag this over here. All right, my folks over there. There we go. All right. And let me open the chat. That's open there. Participants are open. Okay, should be good. But yeah, anytime you have any type of return of premium money back product for the first 1 to 4 years, in many cases, it's going to be a $0 cash value. It's not going to be anything to gain back. Going forward from that point on, it's going to be what we call a small percentage. It'll be a prorated amount of that cash value until that last year to get that 100% return of premium. So like I was telling a lot of the FE guys, we'll get to that question in a second, George. But like I was telling a lot of FE guys, you have come across some of those healthier, younger folks that want to file an expense product. You sometimes can double their coverage with a return or premium product because of this thing called paid up insurance. That's basically like a paid up whole life policy. What that means, so what George's question is, what is ETI? It's extended term insurance. So KCL is really good about, they give you 3 options that basically execute on the return or premium feature. First one, and the most important, is going to be the cash value. That means if you said, I'm done with this policy at the 30-year point, they're going to write you a check for that $45,150, right? Clear cut, no questions asked. Here's every single penny you paid into the policy back. Or you give them say, hey, you know what? Go ahead and keep that money, KCL. I want to take a policy that's paid up. They're going to issue a $103,000 whole life policy that's already paid for. No more premiums needed whatsoever. And his last option is extended term insurance. Only upside of this, it's going to keep the same death benefit of that $250 we originally started with, but it's only going to run out the term for another 15 years and 76 days. So in many cases, I wouldn't recommend the extended term insurance piece of it. I would be looking more or less either at the cash value. If life is going great, nothing changes, I tell my clients to probably end up taking the cash, where they still have enough money in their pocket, as well as they can put up $5,000 to $15,000 for burial expenses and so forth. Or if their health changes catastrophically, it would typically make more sense for them to take the extend or paid up insurance piece of whole life. No more payments necessary. They're basically trading $45,000 for $103,000 of a paid up policy. That's typically where that one makes the most sense. If something changes health-wise, where it's a lot more difficult to get insured at a reasonable rate. But that's the quick crash course on ROP. The pitch, mine's very, very simple. You can rent it or you can own it. So the rental side will be a basic term option, which in many cases runs about half of this price or about 20 to 30% cheaper a month. Same great benefits of just like you rented a house, tends to be a little bit cheaper. At the end of that policy, if nothing happens, you go your way, they go their way. Everything you spent was just for that peace of mind, right? Ownership, or that what we call return of premium, IULs, depending on the structure, depending on the actual situation, it's going to tend to be a little bit more expensive like owning a property is, but you're getting some type of return on investment or some type of cash being built for equity, to use same terms of relating to the actual house in a mortgage protection sale. You're building equity inside that policy where at the end of that 30-year period, if nothing happens, you're getting all of your money back. Or if it's an IUL style product, you're getting a little bit of interest gained on that money. So you have something to show for at the end of the actual policy. I basically phrased the question. Would you rather rent the policy or would you want to own the policy? And that's a very, very strong question to get them to drive you directly to that point of what they want to do. Rent it or own, and then from there, I'll give them my 3 option close. Luis, you want to touch on anything with ROP, or do you want me to dive into IULs?
We're going to go into the IUL now.
Yeah, do you want to touch on anything on ROP?
I do actually, 100% would. I love the explanation and how you're showing everybody to do it. But I want to give everybody that's going to be on the call the opportunity to also ask questions in between and just get a good understanding of it, right? I think we got to go back to the basics a little bit and explain, when is it that an ROP is better than an IUL? How would you answer that, Marcus?
It's for my clients that want a for sure number. So the clients that are more conservative, they don't really like risk. The riders that come with this policy, it's a good question, George. So this policy comes with chronic, critical, and terminal illness. These 3 things that are checked right here, that's what those all stand for. It does also include waiver of premium for unemployment if you have the policy active for at least 2 years. You have also the the waiver premium for residential damage. So if a property sustains more than $25,000 worth of damage due to a natural disaster, it'll waive the policy premiums for up to 6 months as well. These are all built-in features to KCL. So, I mean, it's one of my favorites. Like I said, anytime ROP stuff, I'm using KCL as my go-to company. But I said, this is for the for sure client, the for sure person that wants a clear-cut answer of, I'm putting in X and I want to get Y out. this is where I kind of gravitate towards my return of premium clients. So you're probably looking between folks 20 to 50. In many cases, this does go up to age 55 on their 20-year product. But for the most bang for your actual dollar and a for sure answer of what money is going to come back, that's where this the ROP makes more sense. People that have a little bit more wiggle room, a little bit more play inside their budget, I'm probably leaning towards an IUL or towards my higher net worth clients. The IUL typically will make a little bit more sense in many cases. Would you agree with that, Luis?
I think I'm muted. I'm not. Yep, I actually would. Let me ask you this. Now, as far as ages, right? When is it that you would probably go ROP over over an IUL? Not so much for a guarantee, just like, where the numbers actually make more sense going this route than any other.
Typically speaking, almost to the point, unless, like I said, unless they have a strong budget, someone that's 45 or 50, there's not enough time for this thing to grow. It's not enough time on an IUL to gain that compounding interest and for it to make sense long term. Now, if we're looking at a longer play where, hey, we're really trying to get this to age 95 or to age 100 play, but from a retirement standpoint, I mean, you really want to get into IULs 30, 40, 45 at the very, very latest, unless you have a strong budget to basically excel the actual policy, kind of get it to kick off a little bit quicker than normal. But you'll see a big difference of cash as well as premium if you buy an ROP versus an IUL later. So if someone tells me, hey, I want this as an investment product, I'm 35 and I want to invest in this thing for a solid 20 to 25 years, I'm going IUL all day long. Someone tells me, hey, I like the idea of getting something back, but I don't want to spend too much money in premium and I want to be for sure I'm going to get every single penny back, I'm going ROP. So once you kind of run these things side by side, you'll realize the premiums aren't terribly different. IULs in some cases can run 10 to 20 bucks more expensive depending on the actual carrier and the actual structure of it. But on the IULs, most of those break-even points happen year 18 to year 20, while the ROP, it's the real break-evens depending on what year you select, whether it's 30, 25, or 20. Let me see, and the paid up will stay with the benefit. So the question is, based with ROP, after 30 years, a client can take full premium back to them and the paid up will stay. No, it's either or. So these three options, you don't get both. You're either going to take the cash value, which is the cash, so $45,000 to write you a check, or you take the paid up life insurance, which is telling them, hey, insurance company, keep this $45,000. They're going to reissue a new policy worth $103,000 whole life. Or this third option, which I don't use too often, is going to be, hey, insurance company, keep this $45,000. They're going to extend the original term another 15 years. No cash back or anything for you. They're just going to extend the term for that $250,000 policy. That's where, from a number standpoint, the ETI doesn't make really any much sense unless they're on their actual deathbed. If they're on their deathbed, it makes sense. Otherwise, I'm taking some type of guarantee. Either I'm guaranteeing the cash or I'm guaranteeing the whole life of the paid up policy. I don't really deal with the ETI section.
That's cool. It's definitely a little bit different than you see from some of the other companies, right? And so I think, well, maybe a little bit later in the training, seeing how we're doing on time, let's also go into how to pitch and how to write this. I know Marcus has a great way of showing it. Mine's a little bit different, but I think it's going to be important for people to see how they can use this solution right here to help pitch for a younger customer how to pay their house off 5 or even 10 years earlier. It's all about the way they fund it. And if you do it correctly, it can really save them a lot of money and have them protected throughout the whole time. It's a fantastic.
Oh, definitely. Yeah. I mean, I'll leave the screen up. We'll come back to this one.
They're
James
asking,
Murray, good question.
Yeah,
oh, here, I got a question on the chat. Maximum age for ROP 30 on a KCL. Maximum on the 30-year should be 50, and then the maximum on the 20-year should be 55. You can double check that by typing in right here. If I type in 55 on this, it'll give me an error message. Yeah, 20 to 50, and then if I go down to 20 year, if I typed in 60 or something, it'll tell me 55. So you can double check that by doing that. Let's kick over to Foresters.
I was gonna say, let me go in, man.
Oh, you want to go at it? Hey, here.
Come on, let me go
Here.
for a little bit.
All right. Well, here you go.
There we are. What's up, everybody? So, you guys, Marcus introduced me, Luis Moyano. Been with IFG about 6 months now, and so happy to be over here doing mainly mortgage protection and just like helping people with these products, helping families protect their mortgages, helping families protect themselves, right? One thing that I do want to talk about, and you can probably relate here, Marcus, or we might even have a little bit of a conflicting different viewpoints of this, but a lot of the times when I'm sitting down with people, and here's the reason why I do love sitting on a face-to-face interaction, is because even if we can't make sense of covering the mortgage, because a lot of the times it's not in their it's not in their budget, or they just don't seem to be able to like see how they can get 300,000 at age 60, 65. Well, then we can go ahead and shift it to where we can help them understand that at the end of the day, having some type of insurance is going to be best. And we can go back and forth, whether it's going to be term, whether it's going to be return of premium, whether it's going to be IUL, whether it's going to be whole life. And so mortgage protection sales are really just a way to open the door, help you get in front of somebody, and then figure out what's going to be the best thing that we can do as agents to help them protect their family. With that, let's go into the product that I probably sell the most of. Some people out there are not too in love with Mutual of Omaha themselves. That's whatever. I personally love the company, love the product for a couple of reasons. One, the name recognition, it's probably better than any other company out there, right? They do so much marketing. They spent hundreds of millions or thousands in having that Wild Kingdom show that when we sit with a lot of older clients, they recognize it right away. Or they're saying, hey, man, I get these things in the mail every other day. Like, I'm happy that it's a name that I recognize. So that's good. The product, it's actually very easy to write too, and they're fairly lenient. I do say that just to like be safe, only present this IULE to customers that are very healthy or borderline very healthy, right? If you start seeing a couple of red flags or some conditions that are coming up and you're questioning it, it more likely than not will get declined, or they're going to ask you for additional information. The product that I use is the Index Universal Life Express. And the Express part is what I love, because about 25% of the times I get an immediate decision right there and then saying yes or no. 50% of the times, or 25, I get yes, 50% is going to go back to the underwriting department. And then 2-3 days later, they go ahead and give me the approvals. And sometimes, we just can't help the customers and then we switch. But I'd rather find out as soon as possible when I can't help somebody so I can deviate and see where I'm going to go. So I'm going to teach you guys the Index Universal Life Express with Mutual of Omaha. All right. This right here, the screen that you guys are looking at, is their illustration software. It's called Winflex. You can't just log on to winflexweb.com and start using it. You have to actually call Mutual of Omaha and request for them to give you access. It takes a good 24 to 48 hours to have it functioning and available for you. So make sure you call, make sure you get access, and just play around with it, because it's going to allow you to show an illustration. Showing the actual illustration in the home at the moment that you're sitting with somebody is absolutely like imperative, because it kind of seals the deal for you. So how do I go into it, right? We start off by clicking right here on illustrations. Once you click on illustrations, is going to, and we got like a bunch of people watching on Facebook too. Guys, if you're on Facebook and you're watching, drop some questions. We want to hear from you so we can answer. Our goal for Marcus and myself is going to be to help you. All right. All right, so we're going to start a new case. I'm going to go ahead and use my own information just so it can kind of come up. And right here is the Index Universal Life Express. You open it up, right? I'm 37 years old, so you just put in the client's name. You put in their age, male. I'm in Florida, so that's kind of how you solve it in. In the solve for, you leave it under premium solve so you can put in the amount that you want. Let's say I want $300,000 of coverage. My mortgage is, I don't know, 250. And then the only other thing you need in here to keep it simple for the easy solve is just the agent's name. So you just type in the first name, this comes up, it just populates itself, and you click right here where it says calculate. Click on calculate, and eventually it's going to start thinking about, the actual layout of the showing you the full illustration for the customers. Once you have this, here's how I like to explain it, right? I sit down and I start writing and I break down things for the customer so they understand their options. The more knowledge that they have and the more knowledge that you can go ahead and show that you have, the better it's going to be for all those clients you're sitting with. So I ask them, I'm like, listen, how much do you know about insurance? Do you know like the 3 different options of how you can get it? Most say no, some say yeah. The ones that say yeah, you still go through it, and the ones that say no, you go through it anyway. But you tell them you have term policies. Your term policies are going to be for a season and for a reason, right? It's not going to build up any cash value. Let's say we set it up for 20 years. It might give you the coverage that you need for the house, but after that time is done, it's gone. I literally say it's like you're buying a pit bull to protect your house. While that pit bull is alive, you're going to have coverage and nobody going to come and mess with your house. But eventually when that pit bull gets a little older and he's no longer with you, your house is going to be unprotected. Does that make sense? They say yes. It doesn't get more simple than that, right? Then I explain about whole life and how sometimes whole life is the only option that we have to go, and that's going to depend on their health. It's normally a little bit of the pricier. But what I like about the Universal Life Express policies is that as long as they are funded correctly, and you say that right off the bat, as long as they are funded correctly, they're intended to last well into age 100 plus. What's beautiful about the Mutual of Omaha is that they have it set up already with additional funds going into it to be funded correctly and last forever. So I'm going to show you how. This is the illustration that we're looking at, right? This is the Index Universal Life Express. I always show page 1 or page 2. It tells you here $300,000 for me would cost me $152 a month. That's really good. I mean, I'm only 37 years old, 152. Obviously, term would be cheaper. I'm healthy. I would have no problems qualifying for this. But then I explain to them what else comes with it, right? I tell them about the riders and tells you right here, accelerated death benefit for chronic illness, critical illness, and terminal illness. If you're a brand new agent and you don't know what that means, we're going to simplify it for you. I'm going to show you guys how to show it to them because it is right here. Tells you accelerated death benefit for chronic illness, right? If you're in a nursing home or a nurse needs to come to you for more than 90 consecutive days, they'll pay you up to 80%. Critical illness, ALS, kidney failure, life-threatening cancers, major organ failure, heart attack, stroke, major burns, AIDS, dementia, including Alzheimer's, and aortic aneurysm surgery, things that happen to people, right? Dementia and Alzheimer's, it's the #1 increasing disease right now. Like you're seeing it more than ever before. So for people that don't have any long-term care in their plans or as a program for them, then here you have up to 80%. Right? That's $240,000 that the customer can get to be able to help them handle any long-term care needs. And so if any of that happens to them, they're covered. And then obviously right here, the terminal illness, doctor tells you 12 months or less, the policy will pay out. So then the next page, I literally just go through all these and I go down to page 24. I use it so much that I know what page I want to get to. And this just shows the numbers. Just how Marcus was showing us the numbers for KCL, here we're going to be able to show them how the policy works. So going back, right? Level years 1 to 83, monthly premium 152. It tells you here you have a guaranteed, a alternate scale non-guarantee, and a non-guarantee. This is how I explain it. Guarantee, it's pretty much what the worst case scenario is. The economy has to tank year after year after year. It hasn't happened since the Great Depression. More likely than not, it's never going to happen. Then You go into the alternate. The alternate is just a more conservative way of looking at it. They illustrate it at a 2.75. And the non-guarantee, it's what's been happening and it's more likely than not going to happen. And this is the numbers that we look at. So I show them for 37-year-old paying 152.16 monthly, that equals to 1826 a year. After 10 years, I've put in 18,000. If for whatever reason I want to stop the policy, there should be around $10,000 in the policy. So if I need to end it, I can get around 50% of my money back. Now by 20 years, I've put in around 36,000 and I have just about $36,000. So after 20 years, I've maybe paid $1,000 and then the policy should have the cash value here under surrender where I can end the policy. So if you want to, at this point, you can take it out. But realistically speaking, there's much more of a benefit for me to keep the life insurance for the long run. And here's where I show them, depending on their age, what 30 years does. After 30 years, there's 54,000 in there, but now there should be $74,500. So now your money is making you money just for protecting your family. Do you understand how I'm getting to that? And I always check with them. You got to keep, making sure they're engaged, make sure that they're paying attention and they're following you. And they're like, wow, I'm actually making money on my money. Return of premium is a guarantee. This is not a guarantee, right? But looking back at how it's been going and how more likely than not it's going to go, you're pretty certain that it's going to be around there. Even if you look at the more conservative side, out of the 54,000, you still have 43,000, right? And you'll keep going. The reason why I'm comfortable telling them that this is a policy that's going to help them cover well into their hundreds is because if we look here, this policy in the alternate scale, non-guaranteed, in a non-guaranteed conservative way, this policy is going to last me till I'm 85 years old. Already better than any term policy. And in a non-guarantee, completely illustrated at 5.8, this policy is going to last till age 120, right? And if that's the case, it's going to save up. Now, this is a easy solve. This is just intended to be set up so that the policy lasts for a long time and gives you $300,000 of coverage. The fact that it starts increasing in value is fantastic, but the biggest benefit is going to come into the death benefit. If you have a customer that has more money available to them, right? Instead of just doing the 150, they can do 500, but only need 300. Then we completely change where we're going to go with it. We're probably going to change the product and offer a full index universal life policy that's not express, so they can make that much more money and have that much more available for them for their retirement.
Hey,
But
Luis, does 300 ever go up? I didn't see the bottom. No.
No. I don't. Well, actually, it does. It does. Once your cash value.
For you. Okay. I was looking for it.
Yeah. I mean, I'd be 116 years old with my health right now. I'm easily going to hit that.
Crazy thing, that's $20 cheaper than KCL for the same thing. And you have $16,000 more cash and it's a cheaper policy.
Right. So this is why I have zero problem showing this to many customers, feeling confident that I'm giving them a better product and a return of premium, right? Where, yeah, it's not guaranteed. If you want the guarantee, let's just go ahead and pay the extra $20 at the end of the 30 years. It's going to be there. But if you want to have a little flexibility, have more potential, then here's how we maximize it. So we're actually paying a little bit less, getting you a little bit more, and possibly making money on your money. Make sense?
I mean, that was the biggest thing that it took me a couple years to learn. And then once I cracked that code and the thought process behind it, because every other agent, understand, if they're new to the mortgage protection space, they're selling ROPs just because that's what their manager told them to do. Until I understood what an IUL was, I was always scared that I wouldn't have a policy, wouldn't be enough, how I mess it up along the way somehow. But until I understood the benefits and how to structure it, which someone asked, can you fund the policy properly? Easiest way to explain that, you always want to add $10 to $20 on top of the target premium. That's going to make sure it doesn't lapse upon the actual funding on the actual policy. But until I cracked that code and understood and be able to explain the difference of, hey, this might be a little bit more or a little bit less monthly, but here's the potential you can make out of it, it outshines every return of premium policy. Unless they're super conservative with money, you can almost flip any type of ROP into an IUL and make it a better suited product for the actual client.
Easily. Like, we're going to teach you guys, we're going to help you guys understand what to do that's going to be the best benefit for the client. We're not going to, you know, sell here. We're not going to sell what's best for the company. Thankfully, with the partnership program and IFG, we don't have to do that. We're going to put the products that are going to be best for the clients. Catherine is asking, could you please share your full script, Luis and Marcus? Yeah, we'd be happy to. We'll get into that a little bit later here, Catherine. But just really quick to finish up with the Mutual of Omaha IULE, so we don't take too much time on it. And I'm happy to answer any other questions after that. James is asking, when the client uses the rider at 80% early, do they still need to pay the premium for the life policy? Here's the way that I have it understood, Marcus.
Mm-hmm.
If you go ahead and take an advance, you don't have to take the full 80 advance, right?
Yeah,
If
it
they
depends
offer
on
you
the issue. So it's based on whatever a doctor recommends. So say if it's a heart attack, right? And they deem you having 7 years left, the doctor will write that up on paper, and then the insurance company allocates based off of actuarial tables how much will get paid out of that rider. But the client still pays premiums on the policy. It could be a little bit cheaper though than the original premium. So it's all relative. If they take a lump sum from a living benefit, the premium is relative to what that is.
It's all going to be in a case-by-case scenario, right?
Correct. Yeah.
There's
no magic sauce to figure that
but
out.
Here's,
it's all based on the carrier.
We're all about stories, right, Marcus? And being able to tell the best stories, because stories relate. So I had a colleague of mine previously who told me this story that happened to him. So I use it all the time. I said, listen, there's this guy that wrote a policy out for a young guy in his 40s. He took a policy for $250,000. Shortly after, 6-9 months later, he had a TIA. It's a mini stroke, right? Out of that, because it's a qualifying event, he was able to have the company offer him up to 80%. Out of 250, they offered him $200,000. It's fantastic. You know, like, where else do you get that type of coverage where you're still alive and you need the money for it to come in? He chose not to take the full $200,000. He only took $40,000 so he can get by over the next couple of months, get back on his feet, and go back to work. He did that. The company gave him $40,000. There was still $210,000 available for the policy, and he just kept making his monthly premiums, and the policy stayed active. Do you understand that that's how they work too, Marcus?
Yeah, no, that's exactly right. Yeah, and Sid made a good point. Yeah, premiums based off how much coverage remains in force inside the actual policy itself after the rider's used. So yeah, that is 100% accurate as well.
Beautiful. All right, so I'm going to stop sharing this screen here. Well, actually, the last things I want to show you guys.
Here, what are the pitfalls of an IUL, Louis?
What are the pitfalls of an IUL? Yeah. I mean, it's variable. You know, at the end of the day, there's not a set guarantee.
They're still fixed. It's just not guaranteed. Yes,
exactly.
Yeah, we don't mess with the VULs. We don't mess with that stuff. Yeah.
No VULs. Exactly. It's not variable. It's just not guaranteed. So just because I can't guarantee you something, and this is why I don't use like, a lot of the times I'll go to a customer's house and they're a little bit older, 50s, 60s or whatever, but their kids are 18, 19, 20, 27, 30, right? And I'll sit down with them and then I'll just grab my phone. I'll type in what a GUL is, guaranteed universal life, is for a 25, 26-year-old, and I just slide my phone. Meanwhile, they're about to pay $150 for $100,000. I'll say, hey, look at this. You see that $40 number? Yeah. I'm like, your son's 27? Yeah. He'd pay $40 for the rest of his life, and he have $100,000 just because he did this today. Oh, sign him up right now. That happens so often, and that's how you get 2, 3, 4 policies. So with that, it's not guaranteed. So that's why you have to just say, hey, it's not guaranteed, but what's been happening is most likely going to happen. And here's your conservative, here's your guarantee. On a guarantee basis, you got 20 years guaranteed. Thank you. On a non-guaranteed conservative basis, you're covered till age 85. And what's most likely going to happen, because this is what's been happening, covers you till age 120. So if we want to be a little conservative between the non-guaranteed conservative right here in the middle And the guarantee, you're easily going to be covered into your 90s to age 100, right? So that's how you have pretty good coverage. And for Corey Fenoglio, yeah, this is being recorded. You can watch the recording, or we're going to go ahead and post it again. That's
Express is no medical exam, Catherine. Yeah,
Nothing.
that's what Express stands for. Yeah, so that's what that means in Civic. Thanks for answering that question. But also, so IULs, I think it's Foresters SmartUL. So SmartUL on Foresters is more of a GUL. It's a guaranteed universal life option. I use that a lot just because, like I said, it's all about asking questions and understanding the risk tolerance of the client. Like I said, if they're of the right age, I might be going to an ROP option with KCL. If they're, hey, I want something that lasts me forever and I want a permanent style policy, then I'll be going to an IUL probably with Foresters. And for my higher net worth folks that have more risk tolerance, then I'm gonna be gravitating towards a national life product for my personal liking.
Yeah, me too.
So I haven't touched the MU one too much, because the only caveat I see with the MU product, opposed to an IUL, opposed to or a national life, is that they have like 0% guarantee. That's the only caveat I don't like. While national life, it's kind of hidden inside their paperwork. I believe it's a 2% guarantee, or they have a 2%. There's a special term that they use for over the next 10 years. It's the rate that they average out at, that they're going to pay. It's the only thing I like about National Life opposed to the Mutual Omaha option, but I can probably bet the underwriting on Mutual Omaha is a little bit more lenient. Does that sound fair? Probably.
Yeah. Yeah, it definitely does. Now, check this out. Do this one with my information too, so you can see.
Yeah.
37-year-old male.
Yeah, 37-year-old male, non-tobacco.
Do
This
Florida,
doesn't have.
just as the same.
Yeah, I'll switch it. Yeah. Prices don't change via state, just riders change.
Oh, for real?
Yeah, I just think the same thing. Trust me. So a couple things. I always keep it at DPT. I don't really use the cash value accumulation test too often. On running this one, I always do, typically speaking, it's going to be specify amount, which this matters on Foresters and this matters on National Life. On the Mutual Omaha illustration software, it didn't really give too many options, which makes it easy. Keep the same 300,000. And then the number one thing to change on this thing is we're going to choose the guideline level premium or the Smart Solve. They should be the same number. Smart Solve is slightly different in some cases. But we're at 268. Let me just double check this one. Smart Solve 288. All right, so guideline level is basically keeping the death benefit the same. The Smart Solve premium is going to be the target to 100 premium. You can see this if you do the quote from the actual quoter, forestersquotes.com. The Smart Solve premium is going to say to age 100, or that's what it used to be called. That's going to be the main difference. For this sake, I'm going to leave it as a Smart Solve. I want this thing to last forever. This is more of a once again, a death benefit play, not so much a cash value play. But a couple things I always point out. So you'll get a little error notification here. It says guidelines, premium limitations, year 11. What that means is that Foresters is going to throttle how much money you give them, so it doesn't become taxable. So that's why this year is a little bit lower. This one's year after that's even lower. Then it levels out to this 3227 amount. Like I mentioned before, anything that builds cash, you can't touch it for the first couple of years. And then on here, I always talk about one premium and one premium only. It's the modal premium. I don't really talk about the minimum premium. That gives the client the wrong impression. So the reason why a lot of people hate ULs or IULs, it's because of this thing right here. A lot of agents way back when, 15, 20, 30 years ago, when these first started to come available, they would sell the policies as the minimum option because it's cheaper. It means it's cheaper for the client monthly, and then eventually down the road, they can increase their premiums to this modal or the target premium. Unfortunately, if that never happens, that's where you're starting to see all these IULs imploding from within, or going backwards, as a lot of people call it, or failing, because they're not properly funded. So I disregard this number here. This is a rainy day number. That means if your fridge, you get 4 flat tires, and you gotta pay your electric bill, that's the only time you can pay this the 144. Other than that, this thing is set up at the 288, and this is too much money. We need to adjust coverage and reduce the amount to get it to where it's more feasible. But off the bat, this is $130 more expensive than mutual.
Yikes.
This is a GUL setup. So I'm assuming if you ran the GUL on mutual, it'll be close compared to the IULE. Yeah, run that number. I'm curious. But let's go to 20 years. So we spent $64,000 in cash in this one. We have $61,000 cash value, same $300,000 death benefit. Our break-even point for this particular product, which is the difference between, this is a cumulative premium. This adds up every year as you pay it. This is the cash value. We always want to find the difference. So where they're almost equal. So right here at year 23 is the break-even point. 74,000 spent, 76,830 in cash value. Meaning everything beyond this point, premium-wise, is pure profit. 30-year point, spent 96,000. You got 117,000 in cash. 215. So yeah, it's even cheaper than that one. What are the interest rates on mutual GULE? Do you know?
It doesn't show in here.
Okay, so Foresters is a 2% guarantee. I believe it's 4.1 is their current market rate. This is a SmartUL product on Foresters. So like I said, I'm very partial to these guys. Living benefits are up to 95 per cent. Member benefits are phenomenal, but like I said, they're set up as a GUL product. Almost, 75% of the time you can do an e-app on this thing. You'll get an instant decision, whether it's approved, issued as applied for, referred to home office. These things are turnaround times fairly quick. But like I said, I stick to this product because of the guaranteed rate, as well as they have a pretty good current market rate. No medical exam. So they have a medical exam option, which would be cheaper. That underwriting process is 6 to 8 weeks, requiring a physical. This is all simplified issue up to 400,000 with Foresters. What's the max limit on Mutual Omaha, Luis?
300.
So right there is the $100,000 difference. This is ages 18 or even juvenile, technically 0 to age 75. You can write the simplified issue. It's a very, very strong product, but understand the differences. There is a time and a place for it. Like I said, my client they want some guarantees. They're okay paying a little bit higher premium, or I would adjust the coverage down to where it makes more sense for them. This would fit the bill, personally speaking. But like I said, the big thing with these guys is understanding you want to use smart solve or guideline level. So guideline level, the only difference it's going to have, other than it being cheaper on this end, if you notice, there's no more banner showing that they're going to reduce premium. So this guideline level premium is going to be the same exact premium the whole entire policy. Which still, it's not a bad thing, but the smart solve gives it the extra bump to where you can guarantee you're overfunding that policy on purpose, and then it'll level itself out so it doesn't neck, or what we become a modified endowment contract, which makes it taxable on those actual gains. But it's a great retirement style product where you get a death benefit as well as the cash value. And just like on the Mutual Omaha, once your cash value exceeds the death benefit, the death benefit is going to start going up with it as well. So it's the only policy on the market. As you get older, it's going to give you more coverage. That's one of the major selling points I sell when talking about this product to clients, is showing them as they get older, it's going to increase in coverage, but it does not increase in premium. So like I said, if you use this number, it still performs fairly well. But like I said, the guarantee is being overfunded. I use that smart solve number. Transitioning real quick to National Life Group. I don't think there's any more questions coming in. Matthew Murray, that's right, my friend, pure profit. It's strong. So this one, like I said, new personal favorite, NLG. So number one thing,
really quick, Marcus, before you start jumping into that, let's talk about a little bit about, so price doesn't dictate everything at all times, right? Because if you can't get them approved for one, then that program is nothing to them. It just doesn't do a thing to help them protect their family or their mortgage just like they want to.
Yep.
For diabetics, right? We have the SmartUL, who's a lot more lenient than the Mutual of Omaha. If you happen to have somebody that has a marijuana smoke card for whatever reason, Foresters is like without a doubt the way to go, as opposed to Mutual. Mutual won't take it. But so although it's going to be possibly a little bit pricier, you'll see that there's some other companies that you have more benefits. So that's why it's so important to have a good understanding on your underwriting. So those small little things, and the more you hear them, the more you get into calls like this, you're going to pick up those little things and you'll know where to go. And you don't even show them Mutual of Omaha then, because then it might not even be an option for them. Diabetes, insulin before the age of 50, don't even think about the IULE. Definitely go with the SmartUL. Then at the same time, I've had situations where for whatever random reason, I've been able to beat other policies with the SmartUL. So always check, get a good understanding of where to go and have a couple of looks before you start telling the customer what it is that you want to go with. That way you're doing the best for the customer. And I love this one that Marcus is
We'll
about
keep
to
this
talk
one
about.
short and sweet. So like I said, this is the product I use for my high net worth clients. I mean, we're talking underwriting simplified, potentially without a physical up to $2 million. I think it's 50 grand to 2 million, depending on age for their express underwriting stuff. Standard rates to standard rates to elite. If I'm not mistaken. Let me go back to the client information, double check. Yeah, standard to elite rates. Not going to touch about these ones too much. Like I said, their underwriting is a little bit tighter. That's where they're able to offer some amazing rates, some amazing face amounts. Like I said, these 3 companies we're talking about today, or these 4 companies, are not the end all be all. These are probably just the most popular that agents like to actually use. But for apples to apples sake, we're going to run this the same exact way. But this one is a little bit tricky to run. The way I run my national life is the second option: minimum death benefit, max cash value. So right off the bat, this is saying, hey, I don't care about the death benefit. I'm trying to build cash. You want to run it off the target premium. This is third option here. But typically speaking, this is all based off of what they can spend monthly. So if Luis was quoted the $160 a month or $200 a month, he told me, hey, about $200 a month is comfortable. I'm going to run this backwards first to see where we end up falling. So this is going to be specify amount. That's right. Switch this to monthly, and then my monthly premium is going to be $200 a month. I'm going to let that sit for a second. So right off the bat, looking at this little cheat sheet on this side. So at $200 a month at standardized rates, it gets us about $191,000 death benefit. Now some people are like, well, that's lower than 300,000. It is, but what's going to be different is going to be the cash value. So I believe at 20 years, Luis, you had 58,000, I believe, right? Do you have yours pulled up still?
Let me see. I believe I do. 20 years in, we were at 35,000.
35,000. So yeah. So yes, we have a smaller death benefit here, but our cash value at the same 20-year point is at 59,000. Now, let me just.
Yeah, you're paying slightly over. You're paying $50 a month.
I know. I'm fixing. I just thought about that. That would make it slightly off. 152.
Mm-hmm.
No. All right, so let's get it. So it's about half the coverage.
They're going to be very similar.
20 years, right at almost 45,000. You're at
what? I'm at 35,000, but obviously $300,000 in death coverage.
Yeah.
Mm-hmm. It's just depending on what their goals are, right? If their goal is protecting the mortgage, you want to go with a cheaper monthly. If their goal is having more money available later on, and it's not so much about the actual death benefit, then you max fund it. But that's why Marcus and I keep saying these are for the customers that have more budget. Like usually you're spending $400 or $500 a month into policy like this to be able to properly overfund it.
Correct. No, that's spot on. Like I said, there's 4 different ways to skin the same cat, but it all comes down to asking questions and really uncovering what the client's ultimate goals are. Like I said, we just do this. This is what we do day in, day out. When we're shopping for a client, Now we have a pretty good idea of each of our situations of what we like to go towards. Like I said, this is my high net worth product. I usually spend a lot of time in. Once you do that, spend the time, do the indie work with yourself, run sample cases, pull up older clients that you might have sold an ROP to and look at an IUL, how that would affect them or how would it change the premium. Run those sample cases to get a better understanding for how these products truly work. Or get with us. See, someone, like I said, someone posted a case for $500 a month. We didn't answer it yet, but 62-year-old, $500 a month, no meds, they're healthy. That's awesome. But what's their goal? Are they trying to get a policy to last them until they're 100? Are they trying to build a little bit of cash? I mean, it's a phenomenal budget and the health is fantastic, but the why, the reason that they want something or what they're shooting for matters in picking out which product makes the most sense. Because if he wants a permanent policy, I mean, it could be best to go an IUL route with Mutual Omaha and just lock him in for $300,000 or $100,000 for $500 a month. Or if he's a little bit more riskier, say, hey, I like National Life Group, he might be able to get a better rating underwriting wise. He might come out with an extra $30,000 to $40,000. It just depends on the situation and what makes the most sense. Not a one size fits all. So IULs go wrong if they're underfunded. So what that means, if you look at this sheet right here, an IUL is going to always have something called a minimum premium and then the target premium. If you pay the minimum, which, in order to show that, I got to go to this real quick. Let me run the report. If you pay the minimum, the policy is guaranteed, depending on the company, 10, 15, or 20 years. Most companies are 10 years, which is where, for example, let me see if I can show it real quick. Actually, here, let me do this. I'll do it this way. Death benefit funding, minimum premium. Yeah, it's going to air out first off. It's not available. All right, it's not going to show it. Here. Yeah, so that's one thing. So minimum premium, sometimes they don't even work. But on the illustration, you actually can see it. This is going to be the, which one is this one? This one's guaranteed. Let's double check. Yeah, so this is the guaranteed premium. So even at paying this current premium, this is gaining the guaranteed interest rate, which, like I said, it's an undocumented 2% right here. Like I said, they don't really market that too much. But if you got the 2% on this policy, nothing higher, this thing will lapse in 43 years, age 79, meaning the amount of cash value starts going backwards. It builds up, it peaks, then it starts going right down, using the cash value to pay the difference. So when an IUL is failing, it's using cash from itself to keep itself funded or paying the premium. That's how you know IUL is lapsing. When you have a policy that's making money and going positive, the cash value is actually growing. So in order to make sure this always happens, you want to overfund the policy. I mean, you want to put more cash inside the policy than what the policy is worth. Reason being, the premium is broken down into two different ways. You have the life insurance, the COI, the cost of insurance piece, and you have the investment piece. The cost of insurance on an IUL goes up every single year. There's a fancy chart you can pull up, not on these illustrations, but you guys can pull them up on the back office. That'll show the cost of insurance percentage every single year keeps going up. That's where, like I said, something more guaranteed. A GUL might be a slower pace. ROP is a guaranteed number, stays the same. Those are the reasons why some people gravitate towards that style product versus an IUL. I use the IUL for higher net worth clients because we're investing a lot more money into that premium to where even though the cost of insurance goes up, we are making more money on the interest to counteract that, where the policy will not lapse. That's the balancing act you have to do. The rule of thumb I like to use, whatever the target premium is, $10 to $20 additional will almost always make sure that policy is not going to be underfunded. Even if the interest rates goes to zero for a couple of years back to back, as long as you're overpaying that, it's going to keep up with the cost of insurance. Worst case that happens, the insurance company will not take some of your premium, or they're going to increase your death benefit to compensate. So that's the exact reason why the death benefit goes up after the cash value reaches a certain point. This is to maintain the non-taxable status of this policy. So as long as it's going to pay out more when you die than it does in giving you straight cash, this is considered a life insurance product. That's why it's the tax-free retirement, tax-free growth. That's why John Harbaugh, part of his paycheck is actually an IUL policy. It's stacked up for a couple $1 million of death benefit, but he's making more money tax-free on that actual product. That's going to be the main actual difference. So a lot of people or rookie agents will underfund them to where they're going to implode, where they won't implode on the first 5 to 10 years. We're talking 10 to 15 years down the road. So that's where they won't see it until they're older, sicker, more health challenges. A lot of different things can actually occur. But like I said, this is just a quick crash course on this. Like I said, the easy way to run an IUL illustration with National Life, like I said, I always run mine personally at minimum death benefit max cash because I'm looking from an investment standpoint. Then I'm going to go to specify amount and choose the monthly option over the annual option. So many cases, like I said, if I'm looking at this product, they're spending over $100 a month guaranteed. So we're looking at either $250, $300, $400, $500. I mean, like I said, this don't get discouraged by a lower death benefit. We are building these on National Life for the cash. The whole purpose of this policy is the cash. So when Luis turns age 65, 30 years, if you do the math on that, he spent $90,000. He has $156,000 worth of cash value. He's made almost 60 grand inside of his policy. If you did this, for example, I did my policy. People love seeing this. I bought my policy when I was 25.
2 years ago.
2 years ago, yep.
Mm-hmm.
And I do mine's currently at same $250 a month. Got about a $400,000 death benefit. That's all correct. And make sure surrender value. Yeah, so basically when I'm in my 70s, I would have over $1 million worth of cash value with over $1 million death benefit. Now, I have mine structured for this to happen closer to age 70 than it does age 79, because after the 10th year of having my policy at age 35, my premium is going to double. It's going to turn from $250 to $500. You can illustrate that. It's very complicated to illustrate that, personally speaking. It's a lot of different shorthand code you have to understand to be able to type this stuff in. I recommend calling into the National Life sales desk to illustrate that exactly correctly. Makes it easier. They'll send it over to you, or they'll walk you through it on the actual phone. It's something that I don't teach people to do just because it's
there's just no need. Call us if you need help with that. Let's we're getting close to the hour spot here, Marcus. Let's open up for a couple of questions, see what we have. Right, see, but I think that was an awesome understanding of 3 really good IUL programs that we can use for mortgage protection and the cash back. Oh, it's incredible.
Yeah, or just healthy clients in general. I mean, even on the final expense folks. I mean, this is some advanced market stuff to where there's other products outside of the final expense stuff. If they're healthy and if they're younger, they can still qualify for it. But always use the pension option. Wanda,
let's open up. Just go ahead and unmute yourself, Wanda. I know you have a question.
Yeah, Wanda, you gotta explain more.
Okay, well, this is actually a question that my husband posed to me. Thanks, guys, for talking about a couple of great products. So I don't know if it relates to one of those that could be an option because he's older. He's 62, and he's considering it because, well, he asked, what could I get for life insurance for, say, $500 a month? Because that would be the savings if he set the pension that he has coming to him at a greater, taking the greater one and, now, and then I would get a lesser one later if he dies before I do. So I think, and it's like a $500. Let's see, I'd get $1,400 less later, but $500 more per month now, something like that. So
you have to do the math.
With that $500, if you put
life
it into
expectancy and math, you could make more on the death benefit versus the monthly payout if you live longer. That's a hard one. To be very honest, that is a difficult situation because it's a lot of what ifs.
I know. I mean, typically women live longer and whatever. But he was just saying, what could I get for $500 a month? And I do final expense and go up to 30,000 or 35,000. So I wasn't sure which company I should even explore for that.
Yeah, I mean, health is decent. I mean, I'll look at Mutual Omaha. Once again, if it comes down to, if you're looking at it from a death benefit standpoint, I'm starting to like Mutual Omaha a lot more, just from what Louise showed.
Told you.
Yeah, you're totally right. I mean, if you're looking from a cash standpoint, I'll look at National Life. I mean, because only difference between the two, just so people know, Mutual Omaha is 0 to 5.8% interest. National Life is 2 to right now 6.2 or 6.4% interest. That's why there's a difference in numbers, but it really comes down to death benefit or cash. And
Wanda, let me ask you a couple of quick questions, if you don't mind.
Yeah.
You mind me asking how old you are?
I'm turning 50 in a couple weeks.
Okay, cool. So about 12-year difference there, and then
13 and less than a month.
Give and take. All right, so 13-year difference.
13 years. Yeah.
Now, the $500 on a monthly basis, do you guys need that right now in a monthly survival mode, or is that something that you guys can go ahead and put away?
Yeah, he could put it away.
Okay. And now, God forbid something did happen to you, right? And his income was gone. Obviously, that's kind of, I think, if you can live without the $500 on a monthly basis, then it's going to be to maximize the death benefit. That's going to be like the most ideal scenario. So now we got to find the best way to get us little cash savings and make it be as max on the death benefit. Right. So that way, if anything does happen to you, you're getting a larger number coming your way. And God forbid something happens to both of you guys together, you guys are leaving a lot more behind. I would tell you to possibly look, just because it's a $500 number at 62. See if is your husband very healthy?
Yeah, he's an Iron Man. He can do handstands and whatever.
That's awesome. Yeah. So I mean, I think Marcus is gonna plug it into the National Life Group right there. Oh, look, I'll do a quick one on the Index Universal Life Express.
Will they allow controlled business?
yeah, what do you mean?
Because that's an issue too. I
Both
mean, if
of
I
them actually will.
Oh, okay, great.
What do you mean by controlled business?
Personal. It's a family warm market policy.
Oh yeah, that's fine.
Now they may pay as earned, or there's going to be extenuous caps on that payout, which is normal. Just, I mean, we're looking at, this is running it on purely based off of premium. Once again, like I said, it'll let you overfund for the first 11 years, then it actually goes down what you guys can pay into it later on in life. Death benefits pretty strong until right about the 20th year starts going up death benefit wise, which is good as well. So, I mean, the older he gets, the more it's going to pay out. So I'm curious to see what Luis pulls up on his end. Go ahead and share whenever you feel it.
For sure. I would actually.
UL product?
Flex Life. This is Flex Life with National Life Group.
So go back to the funding here really quick, the death benefit and funding. And let's just change it a little bit because, yeah, okay, you have it based on target premium.
Yeah, I switched it.
$500 a month.
Yeah.
Okay, good.
Yeah.
I gotta get on
I
my
got him
iPad.
141.
Mm-hmm.
You got 141,000?
No, is that what you got?
I got 137.
And that's level throughout. Is that increasing or no?
No, level.
So change it to increasing.
The death benefit?
Mm-hmm.
All right, gotcha.
Right there. Okay.
140.
At first, right? And obviously it's gonna eventually become a lot more.
Yeah,
and
see,
it stays level.
I don't touch that one too often because of this right there.
At age 94. Yeah. So if looking at the IULE on Mutual on a $500 a month,
go ahead.
You're looking okay. Well, I didn't even do the whole illustration. It's $215,000 that you would have as a death benefit forever just by doing $500 a month into that. And so it's a great way of maximizing it. I obviously can't say forever or guarantee, but more likely than not, whenever he does pass, by doing $500 a month, you have $215,000 as a death benefit. That might be the best route to go with it.
Yeah. Okay, great to know. Thanks. Thanks for looking that up.
For sure. We're here to help. I ended up being a private appointment for Wanda. Look at that.
Feels special.
Is that you in your calculator or is that me? That's me. Divided by 500.
Oh, I see did we get that question? Hold on, there's one question. Just cover that real quick. If you use a rider and take 80%, cancel the policy, are they going to require you to pay the money back? The answer is no. Yeah. So they're not going to require you to pay any money back. It's literally getting the death benefit early. They're going to pay out just like as if you died. That's correct.
Cool. All right. Anybody else? We got Josh Spivak here too, saying some good stuff.
Yeah, you can unmute Civic.
Don't say hello, Josh.
You got anything to add?
How y'all doing? Just listening in and taking in the wisdom you guys are laying out there for us.
We appreciate it, man. Anything else you want to add, or anything we might have missed or misspoke on?
Oh no, you guys are phenomenal. You did a heck of a job.
Cool.
Well, hey, we gotta have you on here, man. I know we got Peter Gallagher next week, but one day if we can get you to take a day off of that call or come on at like 10:30 for us, that'll be awesome.
Sounds good to me.
Right on. Well, hey guys, like I said, this is recorded. I'm sure there's gonna be a lot more questions. Do us a favor. This is posted on both of our Facebook pages and on IFG and Friends. Drop a comment with the question. A lot of this stuff is gonna have to be follow-up phone calls. Just to make sure we're clear on certain things. It's very hard to explain it to the masses because each situation is different with IULs. But yeah, don't be afraid to drop those questions. Like I said, we'll get to them throughout the week and just make sure you guys have all the nuggets of information you are looking for. And any type of case design issues, I know James Murray has done a phenomenal job reaching out to me personally, just to help him design some cases and really look at some options. Don't be afraid to ask. We're here to help you. We want to help you guys grow your book of business and understand there are more products available. And we want to help you ensure that you're doing them correctly to benefit the client to the maximum full potential of their actual monthly premium. So, Luis, you got to close out with anything, brother?
No, guys. Again, thank you so much for joining us. If you guys are here and are not part of the partnership model, reach out to Marcus or myself. We're more than happy to tell you about the benefits of how we do things and why we do things. At the end of the day, it's not about us. It's about the value that we're going to be able to provide all of the customers that we sit with. And we want all agents that are watching this to be able to take as much as they possibly can so they can provide that much more value to the customers they're sitting with. We're all building, we're growing, and the partnership model is going to be huge and here to stay for many, many, many years to come. And so jump on board. We'd be happy to tell you all about it. Every Monday, 10 o'clock in the morning, right here. Log on, invite a friend. Let's do it.
Hey guys, let's have an awesome week. We're gearing up towards Thanksgiving. Cannot wait. It's double down on business now, guys. Until then, we'll talk soon. Have a great week.
Later.